You know, they always say the pain trade is what drives the market the way it's going to go. And right now the market continues to go up and up and up every single day, which means that the pain trade continues to be to the upside. Now, it might not be a lot of people shorting the market, but it might be a lot of people that are just missing out. So we're going to talk about, you know, what to do and how you can take advantage of a roaring bull market, but still, you know, be able to manage the risk, because you know there's going to be a pullback. The longer you stretch the rubber band, you know it's got to pop back. It could be a day, it could be a minute in the futures and after hours market, it could be a week. We've seen some irrational markets continue to push that pain trade and hurt the most people possible. Until that rectifies itself, we'll take advantage. So let's go ahead and talk about that. We'll go ahead and get started. Today is Tuesday, January the 23rd, 2018. This is the Market Outlook from MarketScholars.com. My name is David Settle. Thank you very much for watching tonight. Welcome to those that are watching for the first time. Hope you just keep coming back for more. Subscribe to my YouTube channel by clicking that red subscribe button right down below the video there. You can do that right now while you're watching. Also, while you're down there, click that thumbs up icon. It's a one-click way to give me feedback. Lets me know that you like the video, that you want me to do again tomorrow. Scroll down further and comment on anything that stands out to you. I love to hear what light bulb moments you have, what you're picking up from these videos. Finally, in the description, I've highlighted one of the links there to join my daily email list that I send out emails for the market, corresponding to the Market Outlook video every night, with time-stamped hyperlink summaries of everything we talk about, so you can get to the segment you want to get to quickly. Follow me on Twitter for more content in addition to these videos. You'll see my handle on the screen at DavidSettle42. Like and retweet tonight's Market Outlook tweet from there to make sure Twitter keeps pushing you all my tweets. Also, join my Market Outlook community that's on Facebook. You see the address at the top of the screen, as well. There's a link to it in the description down below. All right, well, let's take a look at the S&P 500 first. Kind of running out of things to say about each day's, each day's climb. You can see we've been above 90, this 90th percentile now on the intermediate line since December the 14th. So we're going on more than a month of being up above the 90th percentile. We came down close to it there and close to it. I mean, that's a pretty long time. We had about 3 weeks of being above it there before pulling back down just a smidge below, with some volatility, and the same thing here. But these, we're just not getting, this near-term pullback we had here, which was really the last near-term pullback that we had, wasn't too significant, even though there was some pretty relatively larger size down days in there. The climb since has been breathtaking. Essentially, it's been a little unbelievable, but it's in the direction of the trend, so it's not that unbelievable, because the market tends to go in the direction of its trend. That's why everything we teach always kind of focuses on that. It doesn't mean that it's guaranteed to go up like this. It doesn't mean that there's not any risks that we need to be aware of, even though it doesn't seem like there's any risks that we need to be aware of. We still need to be. I mean, that's a big risk. Coming off support that far, that fast is a risk. And so when you're looking to enter new positions, it's kind of hard on a day like today, or a day like yesterday. But it doesn't mean that we can't, because there's still things that move. So we'll take a look at that. You can see the near-term line is still strongly overbought. So short-term sentiment, again, has been above 50 this whole rally on the S&P 500 here, except for that one day right there. But pretty much the rest of this 3 weeks plus. The momentum line's kind of hovering in the middle of the chart. It doesn't really matter what it's doing right now. As long as it doesn't drop. And you can see we did have an intermediate confirmation signal that we talked about. I mean, I even talked about on the video that day. Probably wouldn't necessarily take that one because of how strong we are. Well, since that intermediate confirmation signal came out, we have been, and I think we even talked about a bullish trade that day anyway. But since that came out, you can see the S&P is up 2.25%, a 220% annualized return over the next 5 trading sessions. So that was a pretty good bullish intermediate confirmation signal that we had there. And now we are, granted, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14 days into this near-term rally. Almost 15. We're a smidgen off of 15 days. And the typical time frame is 7 to 12. And you expect the longer time frames, the earlier you are in the intermediate posture. And the smaller time frames, the further away you are. You can see like we were getting right here. We were starting to get some, this would look like we were starting to consolidate here at that point in December into an intermediate pullback. Nothing significant, right? But at least some intermediate pullback where we get a, like that right there was an intermediate pullback, even though it didn't really pull back that much. So it looked like we were starting to get something again because we were getting a lot of ovals, a lot of near-term highs and lows, a lot of near-term volatility until this one. Bammo! And again, I've been pointing this. Actually, I think I just need to go 2 years back. I've been pointing out this period of time last year. In February was that kind of month that came out of nowhere after being in an intermediate trend this whole time. You can see we had a lot of ovals. Were we going to get an intermediate pullback eventually? Nope. We got that big near-term rally that pushed us up. And that one, we were up above 50 on the near-term line. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 20 days before we dropped. 19th day being the big volume, big trading range, kind of blow off top when we hit 2400. 2400, that seems so long ago. Now we're almost at 2900, and we just keep hitting new levels. When we hit this so far in this calendar year, we've hit 2700 for the first time and 2800 for the first time. And shoot, in December, well, at the end of November, we hit 2600. So it hasn't been that long since we've hit some of these milestone levels and their corresponding milestone levels on the Dow Jones Industrial Average. Speaking of, we'll take a quick look at that one. Market forecast looks very similar. Came really close to an overbought cluster here with the momentum line just a smidgen off. Small trading range today and a little off of the high that kept it from producing that intermediate posture. You can see Netflix really helping the NASDAQ push up. The biggest winner today, 7.7%. It's near-term lines at extreme highs. Very strong posture, very similar outlook to the S&P 500. And then finally the Russell 2000, not up as much. Remember, it had the cluster yesterday with all three lines here. Yes, it was it yesterday. Yeah, all three lines up above 84. So all three lines above 80. With the cluster, still rallied up a little bit more today. A higher high and a higher low, closing up above. More significant than yesterday at the long upper shadow. So good bullish sign. The momentum line pulled back, but again, as long as it doesn't go to an extreme low point, we're okay with any kind of pullbacks there. And eventually this near-term line will pull back too, but it's just now coming off a low point. See, the near-term, the Russell 2000 had a pullback, more of a pullback than any of them. And that's not saying much because that's not much of a pullback, but it had more of a pullback in this calendar year than any of the other indexes that brought its near-term line down. It didn't bring it down on any of the other indexes. So we're bouncing up off of a new near-term low point, whereas the others are still kind of, the last near-term low point they bounced off of was back here at the end of December, at the end of 2017. So to kind of summarize the outlook, it's still strongly bullish. The near-term rally is very mature, but we've seen it more. We've seen it last longer at the end of a long intermediate run. And again, we're almost 5 months into the current intermediate run, so we're probably a lot closer to the end than the beginning. And so we've seen this played out before, where the market just kind of, everything pushes it higher. Everything pushes it higher. Every single day, something else rotates into favor. And that's the case that we're getting the last so many days. But the nice thing is, it's not like we were strongly bullish and all of a sudden we're going down, 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 day after day after day after day. The posture and the trend is strongly bullish, and we just keep going up and up and up and up and up and up and up every day. Now, that impacts whether, for everybody looking for that quote unquote pullback to get in. We're just not getting, we haven't had not even a near-term pullback. And we don't want to wait, because as we've seen time and time again, that waiting for a pullback, we end up waiting a long time. And when the pullback comes, sometimes we don't want to get in because we think, oh, this pullback could be more significant. So we end up not even using the pullback when we get it. So we don't have to wait for a pullback. The posture is currently strongly bullish. The expectation is, any pullbacks we get will not be trend changing. So what we do is we say, okay, well, what kind of strategies and how can I manage my position size so that if today was the worst possible day to get in, I'm not hammered. I can take small losses, but if it does keep going up and with small near-term pullbacks here and there, then I can take advantage of this without sitting it out and wondering what could have been. The long-term trend still shows strong trends, both going parabolic right now. And remember, we don't, I guess I can't say never. We typically don't pull back strong from parabolic when the moving averages, these long-term moving averages, are parabolic. Usually they'll start to flatten out. And so we're obviously not anywhere close to that, because usually we have to pull back at least to the 50-day moving average and start getting some arrows, right? Start getting some arrows. That's when you can see how it went parabolic there and was really parabolic during this move. Then we started to get some, as it flattened out, we started to get some arrows along the 50-day moving average, and the 200-day moving average eventually crept up and caught up slowly. So when you're at this high, it's going to be a while for it to slowly grind its way back to zero, which means you have to start, trading around the 50-day moving average as it flattens out and the 200-day catches up. If you take a look at, again, we like to do this every so often. You can see that MACD on an absolute basis is way up above. It's the 50-day moving average is way above the 200-day moving average. This is how far up above the current price is above the 200-day moving average. More than 200 points, very, very high level. And of course, if we were to take a look at the same thing over the 50-day moving average, over 100 points, highest in the last 10 years. Now, granted, remember, everything's relative, right? You have to look at it compared to the current price. But a big breakout move that we've had here. And of course, you can do the same thing on the 3 green arrows, which we still currently have 3 green arrows. And if you look at it on the 2-line version, that MACD, which measures the gap between the 8 and the 17-day moving averages, is about as high as it's been on the absolute basis. And stochastic's at extreme levels along with its moving average. You can see just how far these things have diverged away from each other. Again, we typically, when they diverge, when it gets extreme and they diverge, we'll start to fiddle around with the 8 and the 17-day moving average while they converge. See how it goes parabolic and then it flattens out. And while it converges, you're fiddling around with these small short-term averages while the 30-day catches up. Then you get your intermediate low point. Same thing on a smaller time scale here. Then they converged, and then you got your intermediate low point. Well, we started to get that here. We really pulled up. And then they started to converge. MACD started to come down to zero while we fiddle around with the 8 and the 17-day. But we never did drop far enough to get an intermediate low point there. It's about as close as we've gotten lately. But we didn't stay down long enough. So right now we're in that mode where, okay, we've got to start fiddling around with the 8 and the 17-day moving averages before we even come close to an intermediate low point. Which I don't even think the next intermediate low point will be small compared to some of the other ones that we've had. So, looking at how far up above the 8-day moving average we are, let's take off that signal chart in the histogram. There's how far above the 8-day moving average we are. We're, it's kind of extreme here. The 17-day moving average, and the 8-day is obviously the one we'll come down and test the quickest. 17-day moving average is extreme. And needless to say, they're all, every single one of these, we are very, very far up above. In fact, if you were to take a look at the linear regression, we are 1 year, we're above the 1 year linear regression. So unlike all the other indicators that base their scale on this column, whether these are daily periods or weekly periods or whatever, this linear regression takes its cues from this column. So the 1-year linear regression, which is what that line in the middle represents, shows the best fit trend line. And look how far away we are from it. We're 2 standard deviations away. We have been, just about every day on the 1-year chart. And what we're now starting to see, though, is on these longer time frames, 2 years. You can see that's the 2-year chart. The 5-year chart, we're outside 2 standard deviations. The 10-year, we're now out, which is hard to get outside 2. We're at, because you can see how we just don't get a whole lot of volatility on monthly charts. We are now above the first standard deviation on the S&P 500, and that's a cash index. Here it is on the 20-day. Now remember too, if you take a look at SPY, which includes all these dividends here, then it's also above. It's 2 standard deviations above its trend line, and the SPY is a little closer. So we're starting to see some extremes. Now, if I go in the other direction, we are starting to slow down a little bit. 9 month is above, 6 month is above. Now 60 days is 3 months. We're 2 standard deviations above. This is on with that dividend payment there. 30 days, now we're only 1 standard deviation above. 20 days, which is the 4-week period, now we're kind of stuck in the middle. We've been kind of slowing down a little. And then 10 days, which is 2 weeks now. So 4 weeks down to 2 weeks, getting closer to the middle. And then finally, to take a look at the last couple of days. And, today, you see how, as bullish as we've been, today we got up and then just kind of went sideways for a while. So, now granted, that's a small time scale. So it's not like I'm saying, hey, we're ending now. But I just wanted to point out, all the time frames that show, it's not too often that you get all these linear regressions showing such a move outside of that second standard deviation channel. It's rare for it to get up above that on a smaller time frame, much less all the other long-term time frames as well. You can even see on this chart how the trading range really kind of tightened up, trading around the yesterday's the 4-week high, which I had actually moved up to this morning. So if I were to trade now, you can see how we're above the 4-week high. The 4-week high now is at today's high point. Trading above yesterday's high, closing at the high of the day. Below the day was relatively early. So similar candle to what we saw yesterday, just a smaller range. Low early, high late, much smaller range. The gap, that 4-week gap, and now we have to kind of move this Fibonacci line up too. Here's the 4-week average. You can see now, and we'll have to move this. Here's the Fibonacci retracement. So, just to kind of show you, this is when the near-term rally started. Pretty obvious low point at the end of the year. So every day this year we've been just rallying higher. Only a couple small down days in the midst. Getting down to 277 right now would be a 38% retracement, and that's a more than 6-point drop. And that's about the halfway point. The halfway point's right around this 275 to 276 area. So again, drop down to there. You'll find some support. But you can trade all in there and not skip a beat, not bat an eye at any kind of pullback. It would just be just simply a near-term pullback there. Very, very wide gap. We don't typically drop to the bottom of very wide 4-week gaps easily. You have to break into the lower half first. That gap has to tighten up a little bit first, and it will start tightening up as we get through past this day of the 29th, and then we just start moving it up to these, each day successive low point. And as we kind of grind in the upper half of the range, eventually we'll move it to where the low point will be the midpoint, and so it'll make it a little bit easier to break that midpoint to the downside. 91.5 million shares traded, very small range, 1.25 points. Much smaller than what we've seen, so still got some high elevated volume, but a trading range that was finally below average with the trading range itself. For us to move up this much and be this bullish with rising, you can see kind of the same thing here that you saw last year. Here, let's go back to 2 years. So here's that period of time where we started to rally You know, and then we hit a low point on volume and a little bit on trading range, and then as we rallied, we were kind of stagnant. We stopped going down like we did here. Well, here, you know, we hit a low point on volume and volatility pretty much in mid-October. Since mid-October, we've been trending higher on this trading range. We've been trending higher on volumes, and you can see, you know, higher highs and higher lows, and you can see since mid-October we are essentially, with this, you know, when we're typically not so bullish, we are now up the 11.25% with a 50% annualized return, with rising volumes and volatility trading ranges. And if you look at the VIX along with that, again, since this mid-October, we might have to go to a 3-month chart. Let's go to a 6-month chart. And you can see right there, we go, right here, mid-October, we were sitting around 9.5 on the VIX when we hit that low point there. Since then, we've had some volatility. We've hit 12 a few times, once a month, right? Because we got to get that trading range on volatility to be, you know, what, 4, 5, 6 points. So that's the same thing happened here. We hit 9 early on, which means we've got to kind of move up to fulfill that range. And you can see even today bouncing up a little bit after pulling back a couple of days. And on the relative basis, you know, we pulled back a couple of days. We're still kind of right around that 85%, which is the top end of that nice bullish move that we've had over the past few months. You know, that's the top end of that. So we'll see if we can get back down below 80% and then kind of grind like we did throughout December. The expectation isn't that we do that. The expectation is, because of the higher volatility and volumes, and again the maturity of the intermediate trend, that will probably bounce off of this and have some higher volatility. Again, not earth-shattering, nothing significant, but enough to eventually produce that intermediate pullback that might not be a turn lower in stocks. It might just be a flat move in stocks, but it would still produce that intermediate pullback that we haven't had for nearly 5 months. All right, now let's transition into what's driving this price action. And a quick reminder before we look at the charts here to like and retweet tonight's market outlook tweets, always pinned to the top of my timeline. The benefit that brings to you is it will make sure Twitter keeps pushing you everything that I put out there. Same thing with Brandon. Same thing with anything that comes out from the Market Scholars account. Those are the 3 accounts. Make sure you are following. Even if you're not a Twitter person, follow those so that you can stay in contact with us, with the content that any announcements we make, any content we put out day in and day out. So like and retweet. That makes sure Twitter keeps pushing you my stuff. The benefit it brings to me is it will make, because it has the engagement, Twitter will start pushing out to all my followers and make sure everybody sees it, even those that are logging in for the first time after a while. So I keep asking. The record that we're shooting for is 150. That's the goal. I think our record's like 120 something. So we're getting closer. So let's see if we can get that record here this week. That being said, let's take a look at what's been driving this action the last couple of days. And you can see it's been crude oil. Crude oil really moving up higher over the last couple of days, especially today. Down a little bit in the after hours with some inventory numbers from API. We've got the EIA inventory data tomorrow morning, so we'll see how long that lasts. But a 2% rise in crude oil, and that's really the only thing outpacing the S&P 500. The S&P 500 is up over 1%. Emerging markets are right there with it after lagging a little bit and catching up here at the end of the 2-day period. You can see all the equities outpacing. Gold doing very well too with the drop in the dollar. The dollar is just really tanking right now. You take a look at the dollar index, you know, dropping now down to 90. And again, just for some perspective on where, you know, how far and where this could go. You know, we're just now dropping below this. You know, this 90 level is an important level. It's more like 80. You know, 88 to 90 in this range. You know, we've been down to 80 right before this middle of 2014 when crude oil really dropped and the dollar took off. We were down at 80. That was at the end of QE3. QE3 was tapering off throughout 2014, finally ended there. The dollar rallied at the end of that tapering. And so with the rise in yields that we're seeing here, the rise in yields up to 2.6%, trying to get up above those, trying to get, strongly up above 2.6 and kind of hold that breakout to make it up to 3%. So despite the rise in yields, see, there's that middle of 2014 when the dollar took off, yields didn't take off. It's the other way around. Now the dollar's dropping, yields are rising, and bond prices are dropping. So that's kind of what we're seeing here. And of course, a weak dollar has its impact. And, this is the impact right here. Crude oil typically does well. And the crude oil commodities typically do well at the end of a kind of a long-term bull cycle that we're well into. And commodities have been underperforming until last year. Finally had a really good year last year relative to other asset classes. Continuing so far in 2018. In fact, if I go to a year-to-date chart of the different asset classes here, which would include basically this rally we've had in stocks up 5.5% for the S&P 500, outpacing the Russell 2000, which is only up 4%. And the same time, crude oil is up 7.5%. That's putting, dollar, weakness in the dollar helps push that up. Yields are rising. Long-term bond, so you can see long-term bond prices. That's the blue line here dropping. And gold doing well. So when gold and crude oil start to rally and the dollar falls, then we know we're in that latter stages, and especially the longer that large cap stocks outpace their small cap counterparts. From a news perspective, we don't have a lot today. Yesterday we had the National Activity Index, which comes out after all the PMI surveys come out. Tomorrow we got a big day. We have the petroleum inventory data from the EIA. We have existing home sales out, so more housing data, and then this PMI composite, this combination of the services and manufacturing. And of course, on Thursday we get some more, and then on Friday we got the GDP revision. So a pretty decently busy report, and of course the GDP right now for Q4. Which we just ended, the GDP estimates, that we just ended obviously in December. You can see now that, and actually now that I think about it, go back to the calendar here, this is going to be the first estimate for the fourth quarter. And again, above 3%, that would be our third quarter in a row above 3% if we were to get that. So we'll see how we play out. It's not too often that the Atlanta Fed is above the estimates of the blue chip consensus. So we'll see, the positive economic indicators we've been getting since the mid of 2017 up till now, starting to pull back a little bit, not having the impact. So you can see there's the middle of 2017 where, interest rate hike expectations have been rallying, coming off of that big increase in economic figures. We've been pulling back a little bit, but that hasn't pulled back these rate hike expectations. Still expecting high odds for one in March, and then still getting pretty decent odds for a second one in June, higher than not getting one at all for the year. There's only one rate hike by June, and you can see the odds of that are falling. And then, of course, September, we'd be looking for a third rate hike, which is getting close. And we're getting close to that figure, those odds being higher than only having two by then. So, and only having one by September is really falling off to where it's a low probability. So most likely going to get 2 or 3 rate hikes, pretty decent odds by September. And of course by December, the odds of 3 or 4 rate hikes are now up over 60% or close to 60%. So pretty decent odds, and they're rising, that we're going to get 4 rate hikes in 2018 that align with each quarter and the press conferences and the dot plots and all that come out during those particular meetings. And speaking of the Fed, today the Powell was confirmed as the new Fed chair. So that March would be the first rate hike that Powell will be presiding over the Fed Board of Governors there to make that decision. Interesting to see how the sectors performed today. The biggest movers today were utilities and real estate. Now, let's zoom out here a little bit. In fact, let's go year to date really quick. There we go. You can see utilities and real estate have not started off 2018 very well. They've got a lot of underperformance to correct. And of course, Netflix, a stock that we looked at for a trade opportunity at the beginning of the year, fueling a lot of that 7.5% rise. In fact, I think since the day that we looked at it in this market outlook video, including today's earnings result, that stock's up 30% now within this time frame. So pretty decent move, helping to fuel a lot of that. Technology up there too. Materials starting to lag behind. So this was an energy materials led market for a while, but you can see materials starting to lag a little bit, and consumer staples, which has been lagging behind, is now starting. It's been a laggard, but still positive. Unlike these these interest rate sensitive areas, they've been dropping. At least the staples have been rising. They're lagging a little bit while these catch up. You can see materials, energy were really big outperformers early in the year, and then just materials just unable to keep going. Energy still doing very well. Halliburton's another one of those 30% movers since we looked at it for a bullish position on one of these videos in early December. You can see healthcare had been performing well, and there's your consumer discretionary with Netflix kind of fueling a lot of that. Alibaba, another long position idea we looked at, kind of breaking out and taking off today. So a lot of these momentum names really helping to fuel a lot of this move on one hand, and then the value, the energy, which had been really underperforming. So again, remember, energy was a big time underperformer for most of last year. Energy stocks were. See, they were just really, they've been rallying sharply. And then there's technology, again, continuing to fuel a lot of this move, up 40% in the last year. The market itself is up 27.5%, 40% move. And you can see utilities and real estate. Utilities have been doing pretty well, but with the rise in yields up to 2.6%, now potentially up to 3%, it's putting a lot of pressure in that particular sector. All right, so for our trade idea of the day, I wanted to take a look at one of these gold companies with the dollar going down and really starting to take off, and gold trying to make a run. Gold's been struggling, and in fact, we were looking at a bearish trade on a gold stock, and that's one of the stocks that have gone against us here in recent videos. Newmont Mining, when gold was breaking down here below 120, has since come back and gotten back up above 120, and is actually trying now on a long-term basis here, trying to make a run. Trying to, again, remember, the dollar's got room to fall. It's not like at a major support level. And if gold makes a run up above, 130 here, and you can see from a long-term viewpoint how far this stock has been up before. There we go. Back again. Remember, the dollar took off in mid-2014. This is about where we were at, and it fell down to 100. You can see a little bit of a kind of an inverted head and shoulders pattern developing. A break above 130 will put now these 2011, 2012 highs in play. This is for the ETF that tracks gold. So you look at a stock like Goldcorp. Here it is. Goldcorp, which you can see its 50-day moving average is crossing over the 200. A lot of times when you get that cross, you'll get a retest of the 200-day moving average. So don't be surprised if you don't get that. The difference right now, though, with Goldcorp, that from a technical perspective, give it a second to load up here on the daily chart. So we broke above 14, and we did it with a lot of volume. So if I were to, I hate when it does that. If I were to zoom in here, and then kind of move it forward, on that day we kind of broke up above 14 the day before, but this was a day that we really kind of took off. So above 14 and a half, and then we pulled back. After that breakout, we kind of pulled back down to 15 and a half. 14 to 14 and a half, area for support, and now we're bouncing back up. You can see we've had one red arrow during this pullback. So a bounce back up then would give us the opportunity for 3 green arrows on a new trend with that with the long-term moving averages crossing over on the bullish side. Now, could we pull back? Yes, we could definitely pull back down to that 50-day moving average and retest, which usually happens after you get that golden cross. Coincidental in this case, that we're looking at a gold company. But considering that all the support you have between 14.5 and these old lows, and this old high point that we broke out above with heavy volume back here with 3 green arrows, then the pullback to these old highs right around 14, multiple touches in this area, a lot of support here. So if you were to put your stop order below that low point, give yourself some room to work with so it can test around in that 13.5 to 14 area. But if we were to hold that support, maybe even trade down in there a little bit, then there might be some opportunity for this to have some run if the dollar continues to be weak. Again, long-term perspective here on this stock and go out even further than the 5 years, go out at the 10 years. And this stock back when the gold was at its 2011, 2012 highs is trading $40 to $50, and we're down here below 15. So there's opportunity for this to make a run up to 20, which is its most recent high. But considering you're coming up off of a higher low point here, the opportunity to break above that in the long term, I mean, not anytime soon, right? But in the long term, there's opportunity here for kind of a longer term play, similar to how we were looking at energy at the beginning of December. So to summarize, there's different areas of the market that continue to take their turns, leading this strong bullish trend higher. And so we're going to look for those opportunities. We've looked at energy, we've looked at consumer discretionary. They both had some good returns, and now we're looking at areas that can benefit from a weak dollar, from a falling dollar, including gold, the precious metal segment in the basic materials sector. As always, thank you very much for watching tonight. Remember to like, subscribe, and comment down below on the YouTube channel. Also remember to follow on Twitter for more content, and like and retweet there to make sure Twitter keeps pushing you all my stuff. And also remember to join that Market Outlook community on Facebook if you haven't already. Have a great evening, everybody. We'll see you all next time.